Welcome to vTalkInsight, Allocator's Lens Daily for December 16th, 2025. We are heading into a week where central bank decisions, key inflation prints, and labor data collide with stretched valuations and an increasingly two-sided AI story across markets. Cross-asset positioning now hinges on how that policy signal mix plays against late cycle growth and quietly rising volatility. In equities, the tone has shifted back toward cautious risk-taking after last week's AI-led wobble. U.S. and European futures are up around 0.5%, recouping part of Friday's decline and pointing to modest gains at the open even as the Nasdaq just broke below its 50-day moving average. The S&P 500 is still trading close to recent highs, and volatility, as measured by the VIX, remains in the mid-teens, which is low by historical standards but slightly higher than earlier this month. Under the surface, leadership is broadening. Equal weight indices are near 52-week highs. European energy and banks are leading, and Chinese retail names are finding support from targeted policy measures. A defining feature of this tape is that AI remains a multi-year growth engine, but markets have clearly moved into a show-me phase. Semiconductor and infrastructure spending is still robust, with deals like Intel's planned purchase of SambaNova reinforcing the build-out narrative, and Alphabet is seen as a key structural winner given its research depth and integrated AI products. At the same time, skepticism is building about how quickly that capex turns into cash flow. Many CEOs expect AI monetization to take longer than investors had hoped. SaaS names such as ServiceNow face rare sell ratings and concerns overpaying more than 20 times sales for acquisitions, and margins for AI leaders could be pressured as competition and power costs rise. Earnings have been heavily concentrated, with the largest tech stocks delivering roughly 200% growth over 3 years versus mid-teens gains for the rest of the market. So any disappointment in that narrow cohort matters disproportionately. This backdrop is encouraging investors to look beyond mega-cap tech. Financials have outperformed technology since early December. M&A activity is up about 40%, and a healthier IPO pipeline signals that risk appetite is broadening. Yet consensus forecasts for around 16% earnings growth next year may be too optimistic. History suggests something closer to mid-single digits could be more realistic, especially after significant downgrades to small-cap earnings. Regionally, the picture is mixed. Chinese equities have held up better than the macro data would suggest, helped by optimism around tech and expectations of further, albeit incremental, easing despite record weak retail sales and the first potential annual decline in fixed asset investment since the late 1990s. European stocks are grinding higher, led by energy and banks, even as auto suppliers and defense names lag on worries about electric vehicle competitiveness and shifting assumptions around Ukraine. All of this leaves equities priced for a soft landing with broader leadership, but vulnerable if labor data or central banks upset that balance. The next layer of that story sits in rates. Rates markets are caught between the reality of substantial Fed easing and a resurgence of global hawkish signals. The Federal Reserve has already cut policy rates by 125 basis points, and two-year Treasury yields have fallen toward 3.5% as markets price the possibility of further cuts as soon as January, even if the odds of an immediate move are still below 50%. Despite that, 10-year Treasury yields are essentially unchanged from October levels, and the yield curve has been steepening. That reflects persistent concerns about inflation staying above target, heavy fiscal issuance, and expectations that other central banks and fiscal trends will keep global benchmark yields elevated even as the Fed trims the front end. This week's delayed U.S. payrolls and inflation data could reinforce or challenge that view, but their reliability is clouded by earlier government shutdown disruptions. Attention now turns to the European Central Bank, the Bank of England, and the Bank of Japan. ECB officials have leaned hawkish in their rhetoric, yet internal forecasts are expected to show inflation undershooting the target through 2026 and 2027, and markets do not see another hike before at least 2027. That gap between language and projections has already forced some repricing and raises questions about how credible a renewed tightening cycle really is. In the UK, GDP surprised to the downside and consumer and labor indicators have softened, with the job market operating below full employment and the risk of a sharper rise in unemployment on policymakers' minds. The next CPI print is pivotal, but the balance of commentary points toward a rate cut this week and a terminal rate near 3.5% by mid-next year. Japan is the mirror image. The Tankan survey has hit a 4-year high and inflation is proving sticky, so a rate hike and signals of further tightening, including ETF sales and more government bond issuance, are in focus. That combination could steepen the JGB curve further and spill over into global term premia. For allocators, this mix creates both opportunity and complexity in fixed income. High-quality bonds now offer yields around 6.5%, levels not seen since the late 2000s, and lower inflation volatility means they are beginning to reclaim their role as a portfolio hedge when equities correct. Market optimism for a broad, easing cycle, reminiscent of 2020, has supported rallies in both bonds and risk assets. Yet the fact that long-dated yields have not followed the Fed lower suggests investors remain wary about deficits and global central banks signaling higher for longer paths. UK gilt investors are favoring the belly of the curve rather than the long end, while in the US, potential deregulation and increased bank purchases of treasuries, alongside Fannie, Mae, and Freddie Mac's larger MBS books, could help anchor duration but also add technical noise. With multiple central bank meetings and key data bunched into a short window, rates and volatility look poised to drive the next leg of cross-asset moves, which feeds directly into credit conditions. Credit markets remain broadly constructive on the surface. European investment-grade debt is seen as more attractive than local government bonds, helped by fiscal support and technical headwinds for German bonds, while peripheral sovereigns offer better carry. European banks are benefiting from stronger deal activity and a positive credit impulse. And frontier markets such as Egypt, Nigeria, Ghana, and Kenya are attracting flows into local bonds and currencies on the back of fiscal consolidation and policy reforms. In the U.S., agency mortgage-backed securities are getting an unusual buyer in Fannie Mae and Freddie Mac, whose portfolios have grown materially since mid-year. That extra demand could support agency spreads and, at the margin, nudge mortgage rates lower, even as uncertainty remains over how much more they will purchase. Combined with a 40% increase in global M&A announcements and a livelier IPO and capital markets calendar, these dynamics underscore that funding is still available for high-quality borrowers. Beneath that calm, however, several fault lines are widening. Intense competition in AI and cloud infrastructure is pushing some technology firms to take on more leverage, raising questions about balance sheet resilience and investor capacity to absorb additional debt. In software, concerns around slowing organic growth and high valuation multiples, as seen in select cybersecurity deals, have sharpened the focus on cash generation rather than purely top-line expansion. Private credit is also adjusting. Funds are building in-house restructuring capabilities and preparing for higher volumes of distress situations, particularly where borrowers are already highly levered. Broader consumer fragility adds another layer of risk. A large share of households report living paycheck to paycheck. Many cannot absorb an unexpected healthcare expense, and affordability pressures in housing and essentials remain acute. Current spreads leave limited room for disappointment. So any combination of weaker growth, stickier inflation, or renewed rate tension could see credit move from quiet support to a source of volatility. Those same forces are shaping currency markets. Foreign exchange is where policy divergence and valuation meet most visibly. Emerging market currencies have gained around 8% against the US dollar this year, helped by the Fed's easing and earlier optimism around a global cutting cycle. However, with valuations now richer and carry buffers thinner, expectations are that those gains may slow to roughly 3% next year. At the same time, volatility across many currency pairs, including emerging markets, has been unusually low in the second half, but is expected to rise as central banks move in different directions and data uncertainty increases. Strategists see a moderate rebound in the dollar by 2026, from near-term lows back toward an index level around 100, which would pressure parts of EM if it coincides with weaker global growth or renewed risk aversion. Near-term, though, the dollar's weakening trend has reemerged, with the euro edging higher and gold rallying. The single currency is viewed as roughly 7 to 10% undervalued, and the combination of Fed rate cuts with the ECB on hold provides a supportive backdrop as long as European growth does not disappoint too sharply. Investors are also favoring currencies backed by strong fiscal positions, such as the Swiss franc, Swedish krona, and Norwegian krone, suggesting that balance sheet quality is becoming a more important FX driver. Dollar-yen is another focal point. The yen is seen as fundamentally undervalued, and markets widely expect the Bank of Japan to hike and signal further tightening, yet the currency has not meaningfully benefited so far. Guidance from a BOJ on the pace and frequency of future hikes, along with plans to sell ETF holdings and increased fiscal issuance, could make this pair one of the more volatile crosses into 2026 as markets reassess the U.S.-Japan rate differential. Elsewhere, currency performance is increasingly tied to domestic policy choices. Frontier markets that are consolidating fiscally and improving transparency are drawing inflows into both local bonds and FX, while China presents a different dynamic. With domestic demand weak, retail sales at historic lows outside the pandemic, investment faltering, and property prices falling, exports remain the main growth engine, and authorities are expected to keep the renminbi broadly stable rather than allow significant appreciation. That stance, combined with only incremental stimulus and rising global trade tensions, limits the scope for a strong China-led upswing in high-beta Asian and commodity currencies. Heading into this central bank-heavy week, FX markets are therefore positioned between a still credible medium-term dollar rebound story and shorter-term weakness driven by Fed cuts and haven demand for gold. How those tensions resolve will have important feedbacks into commodities. Commodities round out the cross-asset picture, with gold sending a particularly strong signal. The metal has rallied more than 65% year-to-date and is trading at all-time highs, reflecting persistent haven demand and concerns about currency debasement amid large fiscal deficits and a rapid but contested easing cycle from major central banks. Gold's strength sits awkwardly alongside still firm equity markets and tight credit spreads, suggesting that while investors are willing to take risk, they're also paying up for insurance against policy mistakes, renewed inflation, or geopolitical shocks. The recent weakening of the dollar and ongoing debates around the sustainability of debt paths in the U.S. and Europe reinforce that demand for hard asset hedges. Industrial and energy-linked commodities tell a more nuanced story. Prices for some industrial metals have shown resilience, but there are growing doubts about the durability of that strength as Chinese data continue to disappoint. Retail sales have slowed to their weakest pace outside the COVID period. Fixed asset investment is on track for its first annual decline since 1998. Housing prices keep falling, and iron ore has dropped toward $100 a ton, weighing on China-exposed European equities. At the same time, Europe is working to secure and diversify access to critical raw materials, including rare earths, through new licenses and potential trade deals such as the long-discussed EU-Mercosur agreement. Those efforts, plus ongoing tensions around Russian energy exports and sanctions on other producers, highlight how geopolitical and supply chain considerations now sit alongside demand when thinking about commodity risk. For allocators, that means watching both Chinese growth indicators and trade policy developments as closely as price charts. Stepping back, the cross-asset picture remains late cycle but still skewed toward growth. Equities are near highs with leadership broadening beyond megacap AI, yet valuations already embed generous earnings assumptions and AI-related balance sheet and execution risks are under closer scrutiny. Rates reflect a powerful but partial easing story. The Fed has cut aggressively, while Europe and Japan are only just pivoting, leaving long-dated yields stubborn and curves steeper. Credit remains well supported for now, but private and consumer vulnerabilities are building, and FX and commodities are starting to price more policy divergence and geopolitical risk, from a stronger euro and fragile yen to record gold and China-sensitive industrial metals. Into this week's cluster of central bank decisions and key labor and inflation data. The main watch point for allocators are clear: whether the soft landing narrative survives tighter financial conditions abroad, how quickly AI CAPEX translates into broader earnings growth, and whether higher long-term yields or a turn in the dollar upset today's cautiously risk on equilibrium. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.